you may have an idea or thesis that you want to do something different. Maybe you even say, hey, I want to be a little bit more aggressive. I heard about this January effect. I've been doing my homework. I like it. I want to add a little bit more stocks to my portfolio.
Do you want a wealthy retirement without worrying about money? Welcome to the Retire in Texas podcast, where you will discover how to enjoy your faith, your family, and your freedom in the state of Texas. And now, here's your host, financial advisor, author, and all-around good Texan, Daryl Lyons.
Hey, this is Daryl Lyons, CEO and co-founder of PAX Financial Group. Thanks for tuning in to Retire in Texas. This information is general in nature only. It's not intended to provide specific investment tax or legal advice. Visit paxfinancialgroup.com for more information. So this particular episode, I want to talk about time in the market, not timing the market. So time in the market, not timing the market, but some very specific things I want to talk to you about that I think you'll find at least to be intellectually interesting. I was doing a little research. I'm not a big fan of multitasking, but I was multitasking because the football game was on and I was researching some stuff on today's topic. And I asked my wife the question, how many months have 28 days? And she looked at me and she goes, 1, February, and that's not all the time. I go, that's not the answer I was looking for. She looked frustrated with me, of course. Like, what are you talking about? And it was a joke. Like, I was like, every month has 28 days. Well, she didn't find it funny. But sometimes when you're doing research for podcasts, that sends you down some rabbit trails of riddles and jokes. And so here we are. I'm going to be talking about the months of the year. And I don't subscribe to market timing. I have tried it before. PAX in 2011. Maybe 2010 had invested a lot of money in market timing tools, some that the systems would turn green lights, buy, red lights, sell. You've seen them on the radio, and I've seen them proposed in various seminars. They just don't work. I've lost a lot of money, a lot of time, a lot of energy trying to do that kind of stuff. So I'm not a market timing person, but this is just interesting information because I'm going to talk about what months are the best months for the stock market. And I asked myself, why do I want to tell you guys this? Why is this even relatively important? I think it's important because I'm convicted that expectations are everything. And I think that's a quote from C.S. Lewis. Maybe he took it from somebody else, but expectations are everything. So when you understand what's going on in the stock market, whether you look at your statements or not, or you hear something on the news and you have a point of reference of why it might be doing that, prevents you from manufacturing a worst case story in your head. And we tend to go there first, a worst case story in our heads. So I'll start out first talking about the worst months to invest. Or let's talk specifically, let's just go right in there. What is the worst month for the stock market? Now, I'm recording this on 9/11, so September 11th. And it just so happens that September is, in fact, the worst month for the stock market, worst month for your money every single decade since 1970. So a lot of people, what they do is they just sell in August. They're like, I'm not interested in September. It has a track record of not being good. And I asked myself, well, why September? And frankly, there's really not a lot of a good reason. Some people say the summer months are pretty bad, and I'll talk about that. But September's kind of a summer month. It's a transitionary month, right? But the summer months are generally months that don't have a lot of activity in the stock market. We can measure volume of trades, and the volume's really, really low. So there's not a lot of stuff going on during the summer. But September is a very, very peculiar month because it's not a good month for the stock market historically. And so you could make the case, I'm going to buy in September or buy late September and enjoy the benefits of October. You could do that. And October generally bodes well. In fact, November is the single best month for stock market investing. So let's say you wanted to be really cute and you wanted to go, I'm going to buy when it's real low in September and make sure that my money's there for the November rally. But then you've got this month in between, October, which is always weird because it's the 10th month of the year, but it has octo in it, which means 8. I think it comes from the Roman calendar, but October is not a bad month either. Except if you look at some crashes, we've had some pretty big crashes in there. Some of you guys might remember in 1987, we had that crash. I think you guys know the oil and gas crisis, the S&L crisis, really scary. The market went down like 30%. So I say all that because September is historically the worst month. October has had some pretty devastating months in it. Not a bad month, but there's just been these weird months. November, moving on to the best month, has generally been November. So you could make a case with the removal of some of these outliers, you could make a case that September's really, really bad, but October, November, and December are generally good months. So September's not good. October, November, and December are generally good. And there is actually some rationale behind why those months are good, because you're having this buildup of Christmas and you have retail sales. So you can imagine we are in September. So every year, December 25th, every single year is Christmas. And if you're thinking about it prudently and wisely, you should probably start thinking about getting gifts now, right? And some people do that. So we've got this build up for Christmas. And as that snowball starts to gain momentum, come December, we've really started to stimulate the economy by money moving and getting in motion, whether people going out to eat or visiting family or buying gifts. This money is in motion and it really helps the stock market. So historically, this October, November, December timeframe has historically been the better months for investing. And again, all this research I'll put in my show notes for you guys so you can see it yourself, but September's not been good. Now, there's some rules of thumb that exist in the marketplace that are important. One of them, I'll mention two of them that are real popular. One is called the January effect. Now, rules of thumb, heuristics, whatever you want to call them, they usually are terminologies that have become nomenclature in the investment world, and some even people consider them true, and January effect is one of them. And this goes back, I think it may go back even to the 40s. But what the theory is that you buy in January and the market goes up in January, because what happened in December is people sold their stocks for a loss and then bought again in January. And so because they were taking a tax loss in December, so they took that tax loss in December, but they want to buy those same investments again in January. And so that gives the stock market kind of this synthetic bump early in the year. And so they call that the January effect. And some people then use those January returns to forecast what might happen the rest of the year. So they say that it's either what's considered tax loss harvesting those taxes in December, buying back again in January, or some people getting material bonuses in January for the work that they had done in the prior year, and they use some of that money to buy stocks, and that drives up the prices of those stocks. And so a lot of people have a strong belief in the January effect, and they also have conviction that whatever happens in January will happen the rest of the year. But if you look at the data, it's really a coin flip. I mean, it works sometimes it doesn't. So, but some people believe it. The data I've looked at, I've been studying finance for obviously since 99, but I've actually looked at this monthly calendar effect for years. The one study I could not find when I was trying to prepare for this was from Brown University. But the main conclusion I drew from all of the research is that there's really not like the secret sauce, so to speak. There's another one that's pretty interesting, though. I think this one seems to have pretty good legs, but again, it's still not conclusive. And this one is sell in May and go away. So this is basically saying stay away from those summer months. Basically, it's saying in May, June, July, August, even September, those 5 months, sell in May, go away and come back in October. Because the volume's real low, people are on vacations, there's just not a lot of money in motion. There's some travel. So that's some people's thesis. Now, it might be true in like retail sales, maybe Gap or whatever retailer you want to put out there. But during the summer months, if you look, there has been some pockets of performance during those summer months. Oil and gas companies, if people are traveling a lot, and the gas prices go up, that'll help their profitability. And healthcare does pretty good during those months. So it's not necessarily a dead month for investing, but the sell in May and go away, a lot of people like that. Again, you look at the research, it's like, maybe. I've looked at enough data over the years that sometimes people take samples of data to make their point, to substantiate their point. And if you extend that data sample period by a year or two, it totally offsets their point. So I haven't seen anything conclusive in any of these heuristics, but I think it's good to know them just to have reasonable expectations. So maybe you're looking at the summer months and you're not seeing performance, you're getting impatient. You maybe even think your advisor's not that good. Just know that the volume may be low during that month for that reason. Or December, you might have lost money and you're now frustrated. You're looking at your statement, you're going to sell, you're going to do something different. You might want to just kind of hang out through January because there's might be some of this stuff going on. So I think just kind of having these expectations, again, not timing the market, but timing the market and having these expectations, a couple little strategies that might be, I think, helpful for you as you construct your investment portfolios. And having this new information about how some of the months work is two strategies. One, dollar cost averaging. Sometimes if you're nervous about getting in the market, you need to be in there, but you're just struggling whether or not you should put that money in right away because you're nervous about maybe even October, because I just mentioned October. You're like, oh, the market crashed in October, I'm going to wait till November. But you're like, I don't know, I still don't feel comfortable. Well, the way to get you off the seat, I think, is dollar cost averaging and working with your advisor and say, hey, rather than putting all my money in at one time, why don't we put 25% over the next 4 months? And the advisor will work with you. And that's just an easier way to get in. Now, here's what you don't want to do. So hear me out here. At the end of 4 months saying, hey, the stock market went up 10% and I only made 4 or 5. What happened? Well, dollar cost averaging means we kept money on the sidelines and we incrementally put it in there over 4 months. So just keep that in mind. But dollar cost averaging is a very good strategy as you are maybe entering the market during a peculiar time period. And then also something that we adopt that we're fairly comfortable with, and I think that you would too, is core and satellite. So what we would do is we would take the core of your portfolio, and many of you guys know what I'm talking about, the core of your portfolio, which needs to be a certain style, let's say 60% stocks, 40% bonds, but you may have an idea or thesis that you want to do something different. Maybe you even say, hey, I want to be a little bit more aggressive. I heard about this January effect. I've been doing my homework. I like it. I want to add a little bit more stocks to my portfolio. Well, what we do is we don't mess with the core of your portfolio because that's your future self. We don't want to mess with your future self, but we might take 5% of it, and we call that a satellite, and we might buy some stocks based on a thesis or an idea. We'll wrestle on the merits of it, but that core satellite says, hey, let's take some of your money and maybe get you exposure based on something that we see in the market collectively that we agree on. So the core satellite approach is really good because you don't go all in on a theory. You maintain the core of your portfolio in a specific structure that will benefit your future self. And you just take little bit of pockets of the satellite to invest in areas like maybe small cap stocks, which seasonally they do good during certain times. And then, of course, dollar cost averaging, those two strategies. So dollar cost averaging, core satellite. And then, as always, just manage expectations through these different months. Hopefully, between now and the end of the year, we get to enjoy this retail sales, this build up towards Christmas, which would be really nice. But you know what? The market has a funny way of making smart people look dumb. So something that we didn't think of, something surprising will likely happen. So just know that that's just a part of the game. And check with your advisor, make sure you're fully diversified, making sure that you got the right strategy. And as always, I just want to remind you in this whole world of investing, the purpose of the investing is to take care of your future self or your family or your legacy. And you do much better when you think different because you think long term. Have a great day.